Hey, what's up, everyone? Happy Tuesday. Hope your weekend was elite. We had one of those beach all day, pretend markets don't exist weekends. And then Monday night hits and the screens are like, surprise, welcome back. All right, listen up, because today's tape is not your normal earnings and vibes day. There are a lot of events coming and the market is suddenly charging an "Are we serious right now?" premium. Let's run the Daily Market Intelligence Brief for Tuesday, January 20th, 2026, Stock Whisperer style. You know those days where stocks are down, the dollar is down, and yields are up, and you just stare at the screen like it's speaking a different language? Yeah, that's today. This is what traders label a "Sell America" kind of tape. Not "the world is ending," but more like, "I need a higher return to hold U.S. risk right now." And when that shows up, you don't argue with it. You respect it. Today's big picture. Story number 1, the tariff threat shock, what traders are calling a "Sell America" tape. According to today's brief, President Trump threatened escalating tariffs starting February 1st on goods tied to a geopolitical demand involving Greenland, and the market didn't treat it like negotiation theater. The tape reacted immediately. S&P 500 and NASDAQ futures down more than 1%, the dollar weaker, and the U.S. 10-year yield pushing up around 4.265%. That combination is the tell. We'll come back to it. Story number 2. Gold going full superhero cape. Gold just broke above $4,700 an ounce to a fresh record. Translation: investors are paying up for safety and political risk insurance. Story number 3. Japan exporting rate volatility. Super long Japanese bond yields hit record highs ahead of snap elections, and we're only days away from the Bank of Japan meeting on January 22nd through 23rd. Global rates don't live in a bubble. When Japan sneezes, global term premium catches a cold. Story number 4. China made the number, but the internals are, hey. Growth came in at 5% for 2025, but it's export-led and demand-light. Beijing is already signaling that support from 2026 through 2030 shifts toward consumption and services. Story number 5. Corporate signals are still alive. GSK buying Rapt for $2.2 billion is a clean signal that Big Pharma still wants pipelines. And on the AI hardware side, the cycle's still hot. Taiwan export orders just hit a record, and Micron is expanding DRAM capacity with a $1.8 billion fab deal in Taiwan. So yes, risk off, but not everything is dead. Here's the key. The real story isn't tariffs. It's that the market is suddenly repricing political risk again, and doing it in a way that messes with the usual playbook. This isn't a normal trade spat. According to the brief, the tariff threats are tied explicitly to a geopolitical concession. That matters, because the off-ramp isn't purely economic anymore, it's political. So investors aren't modeling this as, okay, we'll bargain and settle. They're modeling it as, what if the point is leverage, not compromise? And that's how you get a risk premium. In that environment, who tends to win? Safe havens, gold, Swiss franc type behavior, hedgy business models, quality defensives, defense-adjacent themes. And who tends to get hit first? Europe-exposed cyclicals, autos, industrials, luxury, and high-duration growth that can't handle long yields rising. And Europe already reacted. The Stoxx 600 was down more than 1% in the brief. Another tell. The options market is literally circling February 1st in red ink. This part is sneaky important. Short-dated euro implied volatility jumped, 2-week near 6%, 3-month around 6.025. Sterling volatility popped to around 6.464. Pros hedge FX early because FX is where policy shocks show up fast. So the market isn't just watching headlines, it's pricing a very specific calendar risk window. And then there's the gross part. Stocks down, dollar down, yields up. Classic risk-off usually looks like stocks down, yields down, dollar up. Today's mix is different. It's closer to reduce U.S. exposure. That's why Sell America starts trending in trading chats. And the brief flags another accelerant. Positioning was already stretched. Bullish sentiment, low cash, thin hedges, before this hit. That's how you get air pockets. Macro cross currents you can't ignore. Let's start with Japan, and why you should care even if you've never traded the yen in your life. Japan is a massive capital exporter. When Japanese yields rise, money suddenly has more reason to stay home. And when that happens, it quietly tightens financial conditions everywhere else, including U.S. yields. So if you're wondering why the U.S. long end has been acting a little spicy while stocks wobble, Japan can absolutely be part of that plumbing. Now, China. Yes, the headline says, "We hit 5%," but demand is still the gap. The brief makes that pretty clear. Fourth quarter growth slowed to 4.5% year over year. December retail sales were weak, up just 0.9%. Fixed asset investment fell 3.8% in 2025, and property investment was down more than 17%. Beijing's response is more targeted this time. Support for consumption and services, interest subsidies, and financing tools like a 500 billion yuan investment guarantee plan. That's not a bazooka, but it is an acknowledgement that demand still needs help. What this means for markets. Start with risk appetite. We're in risk-off, but it's a specific flavor, the policy shock kind, where the U.S. is part of the perceived risk, not the shelter. Volatility is telling the same story. The VIX is sitting around 20.25 in the brief, and FX volatility is starting to wake up as we head into February 1st. And then there's liquidity. Think of liquidity like ice. It looks solid until you step on it the wrong way. When cash levels are low and hedges are thin, a single headline can force positioning to unwind. Correlations get weird, spreads widen, and everyone suddenly says they're waiting for confirmation. Translation: nobody wants to be the bid. Sector breakdown, where the tape wants to go. Start with AI and semiconductors, structurally bullish, tactically volatile. Demand is still real according to the brief. Taiwan export orders just hit a record, $743.73 billion, up 26% year over year. January projections are up roughly 46 to 50% year over year. But in risk-off waves, these trade like high-octane assets. They can dip even when the fundamentals are fine, so treat them like a core thesis with tactical entries, not something you chase just because the candle's green. Energy looks neutral. Brent's around $64, WTI around 59 in the brief. Oil's basically saying, show me the demand damage. Tariff escalation is a demand risk, but it's not fully priced yet. Precious metals are bullish, but crowded. Gold above $4,700 is the market buying insurance. But the brief also flags that long gold is crowded. Crowded trades can keep working. It just means your entry matters, and you manage risk like an adult. Financials are neutral to bearish in this specific setup. Higher yields can help bank margins, sure. But if yields are rising because risk premium is rising, that usually means tighter credit conditions and wider spreads. That's not the happy bank rally version of higher yields. Healthcare and biotech look bullish. GSK paying up for Wrapped is a clean signal that big pharma still wants deals. In risk-off tapes, idiosyncratic M&A is one of the few catalysts that can still work. Small caps look bearish. They hate uncertainty, higher yields, and tighter liquidity. In this kind of tape, they're usually the first ones shoved down the stairs. And crypto looks bearish. Bitcoin and Ethereum were down roughly 2 to 3% in the brief. That's deleveraging, not alternative safe haven behavior. Over the next few days, the brief frames it this way. There's about a 60% chance volatility stays elevated into the February 1st window. There's about a 40% chance of a tactical relief rally if messaging softens or Europe finds some kind of off-ramp. But here's the real tell. Do treasuries start acting like a safe haven again? Because if they don't, equity dips are a lot less buyable. Your portfolio hedge isn't working the normal way, and that changes how aggressive you can be on pullbacks. Looking weeks to months out, the risk skew is toward a higher risk premium environment. The brief puts that at roughly 55 to 65%. that supports gold and creates inconsistent dollar behavior. The upside case is still there, call it 35 to 45%, if trade threats de-escalate and the AI boom keeps translating into real earnings and productivity. But the market's going to demand cleaner, clearer policy signals to buy into that path. Here's the don't get blindsided list. Wednesday, January 21st, Supreme Court arguments tied to whether a president can dismiss Fed governors at will. That's an institutional risk headline, not normal political noise. Thursday through Friday, January 22nd through 23rd, the Bank of Japan meeting with the decision due Friday. Guidance is what matters there. Next week, January 27th through 28th, the FOMC meeting. Any hint the Fed is boxed in between tariffs and growth is going to move the curve. Also on January 21st, U.S. housing data, permits, starts, and completions, higher yields show up there fast. And on the earnings front, keep an eye on Netflix. Guidance and strategic direction matter more than the print, especially with media deal chatter in the background. And then the red flags to respect. Watch euro and sterling volatility staying bid into early February. Watch the VIX holding above 20. And watch for more days where stocks are down, yields are up, and the dollar is down. That last one? That's the market telling you the risk premium is still rising. So what's the vibe today? It's risk off, but with confused plumbing. And when the plumbing's confused, your job gets pretty simple. Don't overtrade the chop. Let the calendar guide you. The February 1st window, the Bank of Japan, the FOMC. Stay with quality and catalysts, defensives, deal-driven healthcare, and selective AI infrastructure, but respect volatility. And keep watching the tells, the dollar, yields, and whether bonds remember how to be a hedge. All right, that's your Tuesday brief. If you want, drop a comment. Are you treating this as a dip to buy or a tape to defend? And if you found this helpful, you know the drill. Like, subscribe, and send it to that friend who still thinks volatility is a type of coffee. I'll catch you next time. Stay sharp, stay liquid, and don't let the headlines trade your account for you.